Home prices in your city may be falling fast, but the cost of owning that home is rising even faster. Across Florida, condo values are dropping by 20, 25, even 30%. Yet insurance bills are doubling. HOA fees are exploding. Special assessments are landing without warning. And for many owners, monthly costs are now higher than they were at the peak of the boom. What was sold as a low-stress lifestyle is quietly turning into a financial endurance test. If you live in Florida, or you're thinking about buying there, this isn't just about price declines. It's about whether owning a condo is slowly draining your income, your savings, and your sense of security. So which Florida cities are making homeowners poorer, even as prices fall? To understand what's happening inside Florida's condo market, you have to zoom out first. The U.S. housing slowdown isn't new. Higher interest rates were always going to cool demand. What's different this time is where the pressure is building and how many forces are hitting at once. Mortgage rates didn't just rise, they stayed high long enough to break the math for buyers who relied on cheap debt. Monthly payments surged, not gradually, but abruptly. At the same time, the wave of pandemic-era migration that flooded places like Florida began to slow. Some buyers paused. Others started looking elsewhere. And investors who once absorbed excess supply quietly stepped back. But Florida condos face a second problem, one that doesn't show up in national housing headlines. Insurance costs are being repriced in real time. Coastal risk, storm exposure, litigation, and insurer pullbacks have pushed premiums far beyond historical norms. In many buildings, insurance alone now rivals a mortgage payment. Then came the structural reckoning. New safety inspections, mandatory reserve funding, deferred maintenance that can no longer be postponed. HOA budgets ballooned. Monthly dues climbed, and special assessments, often tens of thousands of dollars per unit, arrived without warning. This is why this cycle feels different. In past downturns, falling prices created opportunity. Today, falling prices are colliding with rising ownership costs. The result is paralysis. Listings pile up. Buyers hesitate. Lenders tighten standards on older buildings with weak reserves, and even cash buyers start asking uncomfortable questions. Florida's condo market isn't just cooling, it's being recalculated. Before we break down 7 Florida cities where this pressure is already reshaping lives and balance sheets, make sure you're subscribed to the channel. If you care about what's really happening beneath the headlines, and you want clear-eyed analysis city by city, like the video, subscribe, and turn on notifications so you don't miss what comes next. Because now the numbers start to get personal. 7. Orlando. For years, Orlando was sold as a safe bet. Theme parks, conventions, nonstop tourism, and a growing metro population created the impression of permanent demand. Condos near resort corridors in downtown were marketed as income-focused assets, units that could always fall back on short-term rentals if the market softened. During the surge, prices followed that story. Many condos climbed toward the low 300s, pushed by investors chasing nightly rates and second home buyers betting on Florida's momentum. But by 2026, that confidence has faded. Across the metro, prices are down roughly 25% from their peak. At the same time, listings have ballooned. Thousands of units now sit unsold, often competing directly with identical floor plans in the same buildings. Price cuts are common. Contracts fall apart. Units reappear weeks later. The deeper problem is cost. HOA fees in many complexes now land between $600 and $1,000 a month. Insurance premiums have roughly doubled since the early 2020s. Add property taxes and today's mortgage rates, and a typical 2-bedroom condo that once cost around $1,800 a month to own can now exceed $2,600. Tourism hasn't fixed that equation. The rush into short-term rentals overshot demand. Buildings near major attractions are saturated with listings across multiple platforms. Occupancy in some complexes struggles to reach 50%, even during what used to be peak seasons. Nightly rates soften. Cleaning fees, management costs, and HOA rules eat into returns. For owners, the fallback option is gone. For buyers, the math no longer works. And for lenders, older buildings with rising fees and thin reserves are becoming harder to finance. So if Orlando, powered by tourism and population growth, can't make condo ownership pencil out, what happens in cities with even fewer buffers? 6. Cape Coral. Cape Coral was once shorthand for the Florida dream. Miles of canals, private docks, sunset views, and waterfront condos that felt attainable compared to South Florida's luxury markets. During the boom, buyers treated these units as can't-miss assets, perfect for retirement, seasonal living, or vacation rentals. By 2026, the numbers tell a harsher story. Median condo prices that once reached the mid-300s have fallen toward the low 240s, roughly a 30% decline. Inventory has surged at the same time, with listings piling up far faster than buyers are willing to absorb them. Units linger. Price cuts stack. Confidence erodes. Insurance sits at the center of Cape Coral's unraveling. Premiums that averaged a few $1,000s a year earlier in the decade have ballooned toward $10,000 or more for many waterfront units. Revised flood maps and lingering storm risk have forced owners into more expensive coverage, often with fewer options. Monthly HOA fees in the $600 to $900 range are now common. Then come the assessments. Roof replacements, flood mitigation, and structural work tied to new safety requirements regularly trigger bills of $20,000 to $30,000 per unit. For retirees who paid cash, the ongoing costs now rival or exceed what a mortgage payment would look like elsewhere. The rental math isn't saving investors either. Occupancy in several complexes has slipped below 45%. Nightly rates soften as competition grows. After management fees, insurance, HOA dues, and maintenance, many units bleed cash. Cape Coral still looks calm from the water. But beneath that surface, buyers are hesitant, insurers are cautious, and owners are realizing that the view doesn't pay the bills. If waterfront condos can't hold their value here, what happens when the lifestyle appeal is less dramatic? 5. Sarasota. For years, Sarasota represented the refined version of Florida living. White sand beaches, a strong art scene, glass condo towers lining the bay. It was marketed as a place where retirees could lock in a premium lifestyle and let appreciation do the rest. That promise is now colliding with reality. Condos that traded near $600,000 at the peak are struggling to attract buyers anywhere close to the low 400s by 2026, a drop of roughly 30%. At the same time, inventory has surged. In many buildings, listings are up well over 50% compared to just a year earlier. Units sit, showing slow. Negotiations stretch out. What's hitting owners hardest isn't just the price decline. It's the cost of staying put. Insurance bills that once hovered around $3,000 a year are now landing closer to $9,000. New statewide reserve rules and stricter structural inspections have forced associations to raise dues sharply. In many buildings, monthly HOA fees alone exceed $1,200 before a mortgage or property taxes even enter the picture. Then come the assessments: concrete restoration, roof replacements, compliance upgrades. Bills of $20,000, $30,000, even $50,000 per unit are no longer rare. For retirees living on fixed incomes, there's no easy way to absorb that kind of hit. Some take on debt. Others sell far below what they once expected. Many simply wait, hoping the next notice doesn't arrive. Investors aren't spared. Rental yields that once looked acceptable have slid toward 3% or less once higher insurance, HOA fees, and vacancies are factored in. Even short-term rentals underperform as competition grows. Sarasota still looks elegant on the surface, but behind the scenes, the cost of ownership is rewriting who can afford to stay. So if even a textbook retirement market is cracking under pressure, where does that leave the rest of Florida? 4. West Palm Beach. For a time, West Palm Beach embraced a bold new identity. Sleek high-rises, luxury branding, and a surge of incoming wealth earned it the nickname the New Miami. Condo prices climbed to levels that would have sounded unrealistic just a decade earlier, supported by the belief that affluent buyers would always be there. By 2026, that assumption is being tested. Median condo values that peaked above $400,000 have slipped closer to $300,000, a decline of roughly 25%. In several high-end buildings, individual units have fallen even further from their original listing prices. Inventory has climbed, and listings that once moved quietly now sit for months. The real shift, however, is happening in the cost structure. Insurance premiums in some coastal towers have tripled, pushing past $12,000 a year. HOA fees have doubled in prominent buildings, landing near $1,000 a month. On top of that, special assessments of $30,000 to $40,000 per unit are becoming increasingly common as boards scramble to meet new reserve requirements and address years of deferred maintenance. Short-term rental math is breaking down as well. Occupancy in many luxury buildings has slipped below 50%, while nightly rates soften. At the same time, lenders are growing cautious. Financing is harder to secure for towers, with maintenance backlogs, weak reserves, or heavy investor concentration. The visual change around the city is hard to miss. Balconies that once glowed at night now sit dark. Agents quietly acknowledge that buyers are submitting offers 20% below asking, and seeing them accepted. International capital that once flowed freely into Palm Beach County is becoming more selective, or bypassing the market altogether. West Palm Beach is still polished and desirable, but the idea that luxury alone guarantees stability is fading. If high-end towers can lose their footing this quickly, what does that mean for markets built on thinner margins? 3. Tampa. For much of the past decade, Tampa looked unstoppable. A growing skyline, expanding job base, and an influx of remote workers from higher tax states fueled the belief that the city had entered a permanent growth phase. Condos near the bay and downtown were pitched as front-row seats to that future. By 2026, the tone has changed. Median condo prices have fallen from roughly $310,000 at the peak to around $230,000, about a 25% drop. In premium corridors near the waterfront, units that once sold close to $600,000 now struggle to reach $400,000. Inventory has ballooned, reaching levels Tampa hasn't seen since the last major downturn. Ownership costs are rising just as quickly. Monthly HOA fees in many towers have jumped from the mid-$400s to $800 or even $1,000. Insurance premiums near the bay have roughly tripled, with some properties facing annual bills approaching $10,000. For buyers using conventional financing, total monthly costs now push well past $2,400. That's a heavy burden in a metro where median household income hovers around $70,000. Short-term rentals aren't providing an escape. Airbnb occupancy in several buildings runs below 50%, forcing owners to cut nightly rates just to stay competitive. In some neighborhoods, nearly 40% of active condo listings already show documented price reductions. Psychology is shifting alongside the numbers. During the surge, Tampa's story was built on momentum. Population growth, cranes in the sky, and confidence that demand would always catch up. Now, construction timelines are stretching. New projects are being delayed as builders rework budgets around higher insurance costs, pricier financing, and slower pre-sales. Tampa still has jobs and growth on its side, but the condo market is confronting a simple reality. Prices and costs can't outrun local incomes forever. If Tampa's momentum wasn't enough to hold the line, what happens when the market depends on wealth alone? 2. Aventura. For years, Aventura was marketed as calm, controlled, and insulated. Just north of Miami, it offered waterfront views, polished shopping districts, gated security, and a steady flow of affluent buyers from New York, Latin America, and Europe. Even when other Florida markets wobbled, Aventura was treated as a financial refuge. By 2026, that sense of certainty has faded. Condo prices that peaked near $600,000 have slid toward the mid-400s, roughly a 27% decline. At the same time, inventory has surged. Listings now linger for months, even in buildings that once moved quietly through private networks of buyers. Rising costs are driving the unease. Insurance premiums across coastal Miami-Dade and Broward County have roughly tripled since 2020, often pushing past $12,000 per year for towers near the water. HOA fees in many luxury developments now exceed $1,200 a month. New reserve requirements are triggering additional special assessments, commonly ranging from $25,000 to $60,000 per unit. For many buyers, the math no longer works. Total ownership costs exceed what a unit can realistically generate in rental income. Seasonal investors who relied on winter demand are feeling the squeeze as occupancy softens and local regulations tighten. Even long-term renters aren't covering the gap created by insurance and HOA increases. Developers and sellers are adjusting tactics. Closing credits, temporary HOA coverage, and price concessions are becoming routine. Agents report slower negotiations, and buyers who now focus less on views and amenities, and more on reserve studies, inspection reports, and insurance exposure. Aventura remains visually striking and undeniably affluent, but 2026 has delivered a clear message. Luxury doesn't eliminate risk. It simply delays when that risk becomes visible. If even Florida's safe haven markets are recalculating, what happens when affordability disappears entirely? 1. Pensacola. Pensacola was never sold as flashy. It was marketed as the middle ground, the more attainable version of the Florida dream. Gulf views without Miami prices, a strong military presence, a laid-back coastal lifestyle that felt stable, practical, and insulated from speculation. That narrative is now under serious strain. Condo prices that peaked around $310,000 in 2022 have slid toward the low 200s by 2026, a decline of roughly 30%. Inventory has surged at the same time, jumping close to 90% year over year in some segments. Sellers who once held firm are now cutting prices just to stay visible. But the real pressure shows up in the monthly bills. HOA fees that once hovered near $400 a month now approach $800 in many complexes. Insurance premiums for waterfront properties have tripled in some cases, pushing past $7,000 a year. With mortgage rates near 7%, total monthly ownership costs often exceed $2,200. That number matters, because Pensacola's median household income sits around $60,000. For investors, the math has collapsed. Short-term rental occupancy in many condo buildings has fallen below 50%. Nightly rates are down. Long-term rents aren't rising fast enough to offset insurance, taxes, and HOA fees. Properties that once looked dependable on paper are now losing money month after month. Then come the assessments. New statewide reserve requirements have forced older buildings to confront years of deferred maintenance. Special assessments of $20,000 to $40,000 per unit are becoming common. Some owners can pay, others list at a loss. A few walk away entirely, leaving associations scrambling and lenders quietly pulling back. Pensacola's downturn cuts deeper because it was supposed to be safe. If even the most reasonable Florida condo market can't survive rising costs and tightening credit, the question isn't where the bottom is. It's who can afford to stay when prices fall, but ownership doesn't. Across Florida, the pattern is no longer subtle. Condo prices fall, inventory rises, and yet the cost of ownership keeps climbing. Insurance premiums surge, HOA fees expand. Special assessments arrive without warning, borrowing stays expensive. And the people who are supposed to stabilize the market, investors, retirees, second home buyers, are quietly stepping back. This isn't a typical housing correction. In past cycles, falling prices created opportunity. Today, falling prices collide with higher risk, higher fixed costs, and tighter credit. The belief that real estate only moves one direction has been replaced by something far more uncomfortable: uncertainty about long-term affordability. What these 7 cities share isn't geography or branding. It's a structural mismatch. Ownership costs have outrun local incomes. Rental income no longer covers carrying expenses. And years of deferred maintenance are being repriced all at once, through reserves, inspections, and insurance. For many owners, the decision is no longer about timing the bottom. It's about endurance. How long can they absorb higher monthly bills? How many assessments can they survive? And how much equity can disappear before staying no longer makes sense? Florida still has sunshine, water, and lifestyle appeal. But in 2026, those qualities aren't enough to override the math. So the real question isn't whether condo prices will bounce next year. It's whether the people who live and work in these cities can afford to own the buildings that shape their skylines. If this video helped you see past the headlines, make sure to like the video, subscribe to the channel, and turn on notifications. And if you're living through this shift yourself, share your experience in the comments, because these numbers represent real lives, not just market cycles.